what do you make out of these levels of crude? And now there's chatter of crude going all the way up until 90.
Yes, clearly. I think, we need to be really watchful on the levels of crude. The fast pace with which we are, breaching 80 and then probably now moving towards 85, that's going to become even more a challenge for India specifically, given the kind of dependency that India has on oil imports rather. And one thing is there, of course, as we approach November 3rd deadline for the Iran sanctions, this kind of volatility in crude oil prices is likely to persist unless we see some kind of a different, verbal intervention by the OPEC and the allied, producers, which in the recent meeting, nothing really concrete came out of, and hence markets have reacted negatively to that. So clearly in the next 2 to 3 months, the supply-demand mismatch is likely to keep the pressure on crude intact, which obviously is not a good news for India. And the oil imports, or the monthly oil imports, if we were to look at from a FY18 perspective, that was broadly in terms of it was around $9 billion. That's closer to $12 to $13 billion currently. So we are seeing that pressure on current account deficit, which is already building up. Apart from that, of course, we have other reasons to worry about, because it's not only about oil. The current account deficit is widening also because there is a structural, the demand side pressures, because India is growing pretty fast, and that is causing increased discretionary demand. Especially I'm talking about electronics, which has seen a huge surge in imports in the last 2 years. Now that increasing trend is something which is also extremely important to address, and we are expecting some kind of measures, but of course the measures could be in the form of tariffs, which probably may not be the right thing, but yes, in the near term that's the best way out for the time being to curb discretionary demand. However, having said that, I think from a little more medium to long-term perspective, the focus on manufacturing base, specifically for the goods and the sectors that cannot be produced domestically, that needs to be really ramped up. And that is the focus I'm looking for, a roadmap which should probably be provided to ensure that there is a much wider focus on building the manufacturing base for things like electronics, which are becoming a problem for the current account sector. So I think all in all, yes, there is an issue for the external sector, especially in this volatile market, because the financing of the current account is also equally important, and that is also remaining, that's also not providing any comfort, because if you look at the kind of pressure that is building up, the current account deficit is expected to be close to $80 billion, of which about $35 billion could be possibly met by FDI, but the balance $45 to $50 billion is the kind of gap which has to be met by volatile components of capital. That remains to be, that remains quite a worrying trend. And
sure.
Yeah.
No, Upasna, sorry, just a minute, and we'll come back to this as well. But just some flashes on your screen, and I don't know which way to look at this, whether to look at it positively or negatively. LIC chairman saying we'll try our best not to let IL&FS fail. Now, does this mean that LIC is saying that they'll put in, of course it means that LIC will put in all the best to come to the rescue, but are they saying that the situation is so dire that unless this happens, IL&FS is sure to fail? And, so two ways of looking at it, but this should be viewed as... well, I don't know honestly how to view it. I think a number of voices have said that why is it that LIC's money gets put in to salvage all the situations? The counter to that is, what options does the government have?
Yeah, exactly. But there is chatter from government corners, and we had been talking about how they're pretty strong on the fact that IL&FS has to probably come out of this mess using its own assets rather than getting bailouts from PSUs, which
they are doing.
Yeah,
the Bloomberg News story support.
Yeah. So there is interest for their assets, 14 out of 25 of their assets. So, while they are taking their own measures, let's see whether or not it is LIC finally that does the deed for it.
Yep, let's wait and watch. Upasna, just one question from Maya, and a quick one at that. How serious, to your mind, is the bond situation? Because while we're seeing the funding costs likely to get tightened for the NBFCs, one because of the ALM mismatch, two because of the likelihood of the RBI uptick coming in not just in October but going ahead as well. Any thoughts on this situation?
Well, I think there are two parts to this. The recent liquidity squeeze that has happened in the NBFC space that we're talking about, that it may be just a little too early to really comment whether this is going to be deep enough or it will be tackled soon. So I'm not sure whether this is really a structural problem yet. But in general, I think there is already a liquidity, structural deficit in the liquidity in the banking system, which was expected to really worsen in second half of the year, given that there is a seasonality that we tend to see every year. So the second half of the year, we were any case expecting that the currency in circulation is going to tighten. There is FX intervention, because unlike every other year when we've mostly seen balance of payment surplus, this year it's a deficit scenario. So there is a pressure in terms of the spot intervention, which is also sucking out liquidity. The government, which has spent significantly in the first half of the year, is now likely to start building up cash balances. So all in all, we were any case looking at the tightness in liquidity to begin from September second half of the year, and that's exactly what's started happening. So I think one is this NBFC issue, which along with the fact that there is a systemic banking system liquidity deficit, it's just probably worsening the scenario, and the short-term rates are likely to remain, are likely to harden significantly on that account as well. Having said that, I think somewhere we do expect that RBI will, on a much more persistent basis, continue to provide primary liquidity through OMO purchases. We've already seen back-to-back 2 OMO purchases being announced in the last 2 weeks, and I think this should continue in the next few months, especially at least 3 to 4 months, in order to try and bridge the kind of a huge hole that is created, and this is something which is structural. This is a requirement to ensure that the economic activity does not get hampered. So I think all in all, yes, there is absolutely a need for primary liquidity infusion, and I think RBI will be vigilant on that front and will continue to try and support the shorter end of the curve to that extent. Having said that, there's a limit to which the OMO purchases will be conducted, and even if we are looking at a close to a 2 lakh crore of OMO purchases in this year, despite that, I think liquidity will remain on the tighter side, which means that the pressure on the shorter end of the curve will still remain.